This is Ralph Sass, and this is the lecture for Accounting 212, Chapter 8 on budgeting. First off is, what is budget? Budgeting is a quantitative plan, okay? And we use it for two purposes. We use it for planning purposes, and then we also use it to control. So we use it at the beginning of the year to plan, to see evaluate what we're going to expect next year, next week, next year, month, what have you, next quarter, and then we go back and we take a look to say, okay, how well did we do in meeting whatever those goals were. So planning involves developing the objectives, and that's the purpose of putting together the budget. And then after the budget is prepared, what we do is we like to go back and take a look and see if our goals had been attained. So that's the control portion of budgeting. Every company budgets, and they do it for a number of reasons. It helps them define their goals and objectives. It helps them plan for the future. It's a way to allocate resources. It also allows them to communicate their plans. It's a great way to communicate what we're planning on doing. Most companies put together a budget for the upcoming year in October or November. So it's a long process, and usually by the end of November, maybe Thanksgiving, it is all done for the next year. Part of the purpose of this is that we are going to hold individuals responsible for things they can control. So if you're in charge of a particular department, what have you, we're going to give you the budget for that department, and then we're going to hold you responsible for what's in that budget for that particular resources and what's going on in that particular department. Budget periods are usually a year. Usually they're broken down then into quarters, so you'll have quarterly budgets, you'll have annual budgets. You may do as small as monthly budgets, although that's a little less common than quarterly and annual. Some companies do what we call a continuous budget, and a continuous budget is a 12-month rolling budget. So as soon as 1 month or 1 quarter falls off, they add another month or quarter. So they always have a plan a year out. I've heard of it done. I've never worked at a company that's done that, but I've heard of companies that do continuous budgeting. The best way to plan a budget is to have it start at the bottom and work its way up. When I was in sales, we'd prepare our sales budget for our particular department, individual, what have you, and then we would have it go up to our boss, and there was usually some negotiation that went on, okay, and then ultimately his budget, when he collected a number of budgets from the salesmen or from the different departments, whatever, and then he put together his budget and proceeded up until it was received by top management. It's one of the reasons why you begin the budgeting process in October or November of the preceding year. There are some advantages of doing it that way. Okay, what that is called is, when you're preparing the budget for yourself, it is called a self-imposed budget. Okay, and keep in mind, some things it does is it makes everybody feel like they're a member of the team. Okay, so that's one of the benefits. It's more accurate. The people that know best what their sales are going to be, how much they can produce next year on that manufacturing plant, are the people that are running that plant or in that sales position, so that it's going to be more accurate. Motivation is going to be higher because they're going to feel they have a say in what the budget is. It's not somebody that told them you're going to sell $1 million and they know full well that's an impossibility. It could very well be, that they're putting that since they put those numbers out there, since they're the ones that prepared that budget, it's going to be a motivation for them. And because of that, they can't claim that it's unrealistic, because they're the ones that in fact created the budget. Self-imposed budgets do need to be reviewed. It's almost always a negotiation process. Salesman says they're going to do 800,000, sends it up to the manager. The manager says, I know you can do 1,000,000, and ultimately what's settled on is 900,000 in that case. But it's often done that way. Okay. Keep in mind there are some human factors in budgeting, and you want budget targets that are achievable. You want top management to be committed to those budget numbers, and you don't want management to blame you when things don't go well. I mean, it's really nice to say, hey, we're going to have $1,000,000 in sales next year, but because of a whole bunch of factors, some of them within your control, but some of them definitely outside of your control, you may not reach that particular budget level. The thing that always amazes me is how many budgets there are. Okay, and this is as simple as they come. And notice here there are 3, 6, 8, 12 budgets. Okay, and this is the simplest of all budgets. Okay, so this would be the minimum that you would ever have, would be 12 different budgets. Notice they all start at the top with the sales budget. Sales budget comes first, and then all the other budgets derive from that sales budget. Okay. So what we're trying to do, and I'm not going to go through all of these, but some things to consider. What are our sales going to be? Okay. How much cash will we collect? Just because you sell something doesn't mean you're going to collect the cash in the same month, even in the same year perhaps. You may sell something in November and not collect on it until March. How many raw materials do we need? Keep in mind, consider a product like a car that has thousands of parts. For some of those you need 4 parts. You need 4 tires for each car, but you only need 1 engine. So you have to have a budget for each of those parts. How many costs will we incur? Bottom line is there are a lot of questions that these budgets help us answer. Keep in mind that everything we're putting together, and it all starts with the sales budget, and the sales budget is based upon some assumptions and estimates, and everything follows from that. So keep in mind, we'd like to think, oh, it's an exact, but it's all based on estimates. Lots of times companies use Excel spreadsheets because it does give them the opportunity to do what if types of scenarios. So starting off with the sales budget. Notice we have the budgeted sales for the next 5 months, and the selling price is $10 per unit. So what we can do is go ahead and put that in an Excel spreadsheet, and notice then what we get here is our sales. And all we've done is taken the budgeted sales in units times the selling price to get total budgeted sales. Simple enough. Now the issue, expected cash collections. Notice what we have here. In this case, all sales are on account, meaning we're giving them some terms, 210 net 30. 70% are collected in the month of sale, 25% in the month following sale, 5% are uncollectible. All of this comes from prior experience. For purposes of this class, I'm going to have to give you all that. Okay? And on March 31st, the accounts receivable balance was 30 grand and will be collected in full. So notice what happens here. My accounts receivable at the end of March, I'm going to collect all that in April, so I'm going to collect that in April. Notice of my April sales, 70% of the 200,000 in April sales are going to be collected in April. The other 25% are going to be collected in May. Keep in mind that 5% is uncollectible. And we can do the same thing for May. And we can do the same thing for June. Now a couple of things to note, okay, and this becomes very important. Our April sales were 200 grand. We only collected 470 grand, or pardon me, 170 grand. We didn't collect as much as we sold. So that means we don't have as much cash. So how are we going to pay our employees, pay for our supplies, whatever, if we didn't have as much cash as sales? Notice May. We sold $500,000. In May, we only collected 400 grand. Okay? Once again, this is why these budgets are so important, because they're going to give us the tools necessary so we can go to our banker perhaps and say, hey, we're going to be short on cash in May. Can we borrow some money to hold us over? Once we have the sales budget completed and cash collections, then we need to go on to our production budget. Now, once again, all of these numbers we're going to have to give you. Management at Royal Company wants ending inventory to be equal to 20% of the following month's budgeted sales. Keep in mind, you don't want that number to be 0. Why? Because you fully expect that there are going to be some sales on the first of the month, and if you don't have any in inventory, how are you going to sell them and deliver them? So you need to have some of the next month's sales in inventory. So we have here on March 31st, 4,000 units are on hand. Okay, so our budgeted sales are there at the top. We have that from our sales budget. Then we have to add our desired ending inventory. Notice what they've done here. They've taken the 50 grand from May sales, multiplied it by 20%, and said we want 10 grand in inventory at the end of the month. So we need 30 grand, 30,000 units. We've already got 4,000 sitting in inventory, so we have to produce 26. Once again, notice my sales are 20 grand, but I need to produce a different amount, 26. Okay? Now, as we move forward, notice the $10,000 of desired ending inventory in April becomes our beginning inventory in May, and once again we do all the same thing. Okay? There's our 20%. Okay? And total is 56 minus our beginning, and once again we're going to produce a different amount than we're going to sell. And finally we've got June there. And a couple of quick notes. This last column, this column for the quarter, always throws everybody off, because when you start to think about it, those there are summed to equal the 100,000, but the 5,000 is just coming over. The 4,000 is coming from over here. Okay, so some of the numbers are added throughout the months, April, May, and June, but some of them are carried over from either June or April, depending upon what it is. So you have to put on your thinking cap, so to speak, and realize where the numbers are coming from. Direct materials budget then. Now keep in mind, we've put together a production budget. We know how many we're going to produce, and now we have to figure out how much materials we need. 5 pounds of materials are required for each unit. Management wants materials on hand at the end of each month equal to 10% of the following month's production. Once again, you want some on hand, so on day one you've got some raw materials for your employees to use, and the cost is 40 cents per pound. So now we're going to take our production budget, which came from our production budget numbers of 26, 46, and 20. Each of those we're going to multiply by 5. Why? Because each unit of production takes 5 pounds of material. Keep in mind, this is probably assuming no waste. Okay, so that tells us our production needs. Then we add the desired ending inventory. How do we get the 23,000? Well, we want 10% of the following months. So we want 10% to 230 grand, that's 23 grand. So we need 153,000 pounds of material. We have 13,000 at the beginning, and so we need to purchase 140 grand. Now our purchasing manager can go out and buy 140 grand worth of material. And we do the same thing for May, June, and July. Notice once again the ending inventory in April becomes our beginning inventory for May. Okay, and we do that all the way through. Once again, note that when we get here to the end, okay, that 11.5 is coming from there. That 13 grand is coming from there. And those are equal there. Those are equal there. that's going to be equal there, and that's going to be equal there. So once again, some of the numbers are coming from the beginning and some of them are coming from the end. With that, I'm going to stop this video and we'll pick this up with the second part of this lecture.